Hello and welcome to our RVA Wealth Management's quarterly market update. Mike and I are here today to talk about what we're seeing in the markets and what we've been doing with the portfolio and how we're positioning things given current market conditions. So appreciate you taking some time out of your schedule to listen to us today, and I hope that this is very beneficial for you as we go through it. This is the fourth quarter, so we are going to be talking about what we're seeing right now as we finish up this year and what we're sort of thinking about going into 2024. So that's what we're going to be covering today. This is the team. I did want to mention that we do have one team member new. Robin Colton joined us. She came over from Ameriprise. She is an advisor, and we're looking forward to working with her and being a part of our team here. So welcome, Robin. If you see her, her office is next to ours currently, but soon we'll be moving. That's the other announcement I did need to make, that we will be moving in December to our new space at 4510 Cox Road, the old Cap Center building, just down the street from us here. So we'll have an open house probably in January. So welcome to Robin, and the rest of the team is always here to serve you any way that you need us for. Quick on the disclosures. We talk about indexes in here quite a bit. The disclosures talk about what those indexes are, what they're used for, what diversification is, and some other information that obviously is important for you to remember when taking into consideration anything in here. And keep in mind that any opinions, projection, forecast, forward-looking statements presented are valid as on the date of this document and are subject to change. Keep in mind that there are risks investing both in equities and in fixed income. If anybody tells you that there's a risk-free investment, run as fast as you can, because there's no such thing. First and foremost, the economy remains very resilient this year despite the increased interest rates and inflation. So we're chugging along at a very nice pace. The GDP in the third quarter was, I think, 4.9%, which was a surprise to the upside. Profits have been coming in pretty strong this year. So all in all, the economy continues very strong, and the job market also continues to be very robust and actually tight, so we're not seeing any layoffs out there. So no recession in sight at the moment. Now, these low interest rate debts that are out there currently, because prior to this rise in interest rates, we were able to finance things at a very low rate. Any of you have a home mortgage at 3% or less, you know what I'm talking about. You're very lucky to be able to finance at those low rates. The same thing was true for corporations and governments, by the way. But as this old debt matures and people are going to have to refinance at these higher rates, we could see some concerning constraints out there. And I think that's really, in many ways, the purpose of higher interest rates by the Fed, is they're hoping that that'll slow things down, cause people to stop borrowing, cause new activity to slow down. And despite this economy's resilience, it is showing some signs of slowing down. So we would not be surprised to see a recession in 2024, given the fact that we've had an inverted yield curve now for a year and a half, and historically we've not had inverted yield curves where we did not see a recession at some point in time following that occurrence. Now, we do think that stock market valuations seem somewhat extended relative to corporate earnings and interest rates. Higher interest rates should be compressing stock market valuations quite a bit. They did it first, obviously, last year as interest rates rose. We saw a pretty big compression in the valuations out there. Stock market dropped considerably. But this year it's bounced back quite a bit, and so we do think prices are currently extended relative to what we're seeing from earnings and interest rates at this point. Despite the challenges we've seen in the bond market, because what has it been, Mike, 3 years now, the bond markets, or 2 years?
This will be the third consecutive down year for the bond market.
Yeah, that's just unheard of, really. We haven't seen that since the 50s. I think it's, since the 70s, really.
Right.
It may be even worse than anything we saw in the 70s. I don't know if we saw a consecutive time period where the bond market was down to that long. With that being said, however, given how high rates have run and where we sit, and we do see inflation start to cool a little bit, we think there's a big opportunity going forward in the bond market, especially if we do get some kind of recession next year. So let's talk about the S&P 500 index a little bit. Mike, I'll let you kick in here.
Yeah, this year has been very interesting because the S&P from March to probably late summer had a really nice run, but it was primarily driven by the 10 mega tech stock names out there. Had a really nice move, driven by a lot of the excitement in AI developments, and these tech companies also became somewhat of a defensive investment with really strong balance sheets.
Right.
And so if people were going to put some money in the market, they went to those safer bets in their opinion. So they had a really nice run, but recently they have pulled back over the last few months here. What's interesting to note, though, is if you the S&P is market weighted, and so these big names have a very heavy weighting and influence on the S&P. But if you did an equal weight on the S&P, and the general stock is about down 2 to 3% on the equal weighted market, so the S&P's move up is a little misleading.
Yeah, and I think those we call them the Magnificent Seven stocks. The big boys, the Microsofts, the Apples of the world. You look at what they're up this year; they're in the 50% kind of category. I think Nvidia is up even more than that. So big moves in those stocks, whereas a lot of the rest of the market was negative.
Yes,
and in some cases, in a big way, with a lot of stocks that we saw out there.
So always watching the valuations very closely, and you can see this is the forward price to earnings multiple that we're looking at, and a few years ago it was really elevated. We had over 20 and a half times on the forward price earnings multiple coming into the 2022, and it's come in significantly, as you mentioned, with interest rates moving up. But we're still above the historical average. The 25-year average is 16.7, and at the end of the third quarter, the multiple was 17.8. So still a little pricey measured versus history, but well better than we were a couple of years ago.
Yeah, and if you look historically, we saw those elevated prices that we saw in 2021 were similar to what we saw back at the end of the 1990s.
Yeah, the dot-com bubble. That was the last time we saw multiples this high. So
very, very, very similar kind of, and we can sort of see what happened following that big high. You can see, eventually, we had a little bump up. I mean, actually, the chart's starting to look similar when you look at it. We had that little bump up, and then we had the big drop off in the 2008. So hard to say where we could go, but this is why we think that valuations do appear to be a little bit high at the moment in the stock market.
The corporate profits have been excellent. If we focused for the time being on the left-hand slide, blue is the consensus estimates from analysts going into next year. So we've had a pretty good earnings year this year for companies, and they have been able to produce really nice margins. But what's interesting is everyone's talking about the upcoming recession. Will it be a soft landing? Will we have more of a severe recession? The average analyst is still projecting around a 12% increase in corporate earnings. So it's sort of like something has to give here.
Yeah, I was looking at this slide a lot earlier and thinking, what is the impact? It's almost like, and you think about this, all the corporate leaders, they're always projecting an increase. We're going to have increased profits.
Right.
But I think this year we have seen increased profits. But as you can see, it's been driven primarily by margin, which means, by the way, their ability to raise prices, not by new revenue. That's been the driving force. They haven't been increasing revenues. They've just been increasing margin, which has helped profits, obviously. Don't know that they can continue to do that. I think there's going to come a point where the market says, no mas, we're not buying anymore at these prices. And it also will open the door for disruptive new companies to come in and take market share from companies that have really priced themselves out. So we'll see how this plays out. But yeah, I mean, the consensus is no recession in the near future from the analyst side of things. But we'll see.
All right, this could be a scary chart. I just want to warn some people. We're going to talk about federal finances. Ooh. And we're recording this just after Halloween.
Yeah.
Bottom lower right hand is the federal net debt. So the percentage of debt as a percentage of GDP. So you can see as we financed World War II, we were over 100% debt to our GDP, which is understandable. And then we made a significant downward slope all the way through the 70s, and it was manageable early 2000s, and it's been creeping up ever since. But what happened during COVID with all the basically giving money away, we went right back to 100% during COVID. But unfortunately, we've continued the trend upward. Now we're at 118% debt to GDP, which is it's pretty concerning.
It's very concerning. Obviously, you can see that that's a record high. The United States has never had a debt to GDP ratio that high. And even after World War II. I mean, it's really concerning.
So I think the government was really comfortable with printing more and more and issuing more debt because interest rates were so close to zero for so long, they sort of were getting away with it. And but if you look now at the chart on the left, the federal budget, we are talking about net interest expense of 10% of the federal budget. I mean, that is, now we're talking real numbers here.
Yeah.
Just to put that in perspective, the defense budget is 14% of our federal budget. We're going to pay 10% in interest expense.
So almost as much as our defense budget that we paid in interest. That is a bit scary, but and that's going to put a lot of pressure on the politicians to have to take some action and do something from a spending constraint standpoint, I would think, or raising taxes. Either one is not going to go over well with anybody out there.
No, because you look at the major expenditures. No one's going to want to touch Medicare or Medicaid. 28%. Social Security is untouchable. That's a great way to get yourself out of office if you start cutting there.
And given what's going on in the world, do we cut defense spending? I don't think so.
No, if I was a betting man, I think defense spending is going up.
Yep.
And the non-defense discretionary, that's 15% of the budget. That's not a lot to work with there. So it's going to be a very interesting political scenario here coming up.
Yeah, that's an understatement.
All right, how is the consumer doing? How are they held up? Remarkably well, as you mentioned. Part of it is because of the job market's been so strong, and they have also seen wage increases that they hadn't received over the last few years. Employers played catch up last year and early this year, so the consumer's been in good shape. And what they have done really well, really since the housing crisis, is household debt has come down significantly. So top right-hand slide, household debt service ratio is what are your debt payments as a percentage of your disposable income. And that had dropped significantly since 2007, but we're starting to see that tick back up a little bit here. Still manageable, but we'll have to watch that.
Yeah.
So what we're seeing now is some early delinquencies in auto and credit cards, and now student loans are you need to start making your payments again on the student loans. So I think that's about a $500 a month payment, which will take a bite out of a lot of the consumers.
Yeah, when you look at the percentage of student debt of all liabilities, it is a really high one. It's 9%, and that is going to have since now people are having to pay that. But just think about this. You had the Biden administration sort of promising all those people with student loans that they're going to be forgiven for a long time, and they put everything on pause, and nobody had to pay for a couple of years. So what happened was, and this doesn't surprise me, sort of natural. People went out and took on other debts, auto loans, revolving credit debt, things like that. And now they're going to have to start paying their student loans back. Well, what do they do? So it's going to either cause default in student loans, or it's going to cause a real spike in auto loans and credit card defaults. I have a feeling. Bankruptcies, I have a feeling.
Yeah, because the price of autos have gone up significantly in the last few years, and you have a higher interest payment on that. So those are big car loans.
Yeah, this student loan thing, I think, is an underestimated impact in terms of what it's going to have on the economy as a whole. Having to have the people start, having paused it and now having to have them pay it back when they thought it might be forgiven, it's going to be challenging.
This is inflation, the core core CPI numbers here. Inflation has backed off considerably since we peaked July of last year. So we're trending now around 3.9%. So a lot better than we were looking last year. The Fed would still like to see this number closer to 2%, which is probably challenging unless we do see a bad recession. We're still well off the target, but it's been trending in the right direction at least.
Yeah, but you do sort of see when you look at that chart, and the gray lines are recessions, by the way, and you can sort of see that when we've had spikes in inflation, historically they've been followed by recessions. So again, this is another indicator that we could be looking at some kind of or some form of recession in the not too distant future.
All right, oil markets here. Oil, it's been interesting because you would think with all the turmoil in the Middle East, the price of oil would have spiked, but actually, even since the end of the third quarter, when this chart shows about $90 oil is backed in a little bit even further from that, which is a bit of a surprise. But we do like oil right now in energy stocks. We have a overweight to those. These oil companies have done a really nice job recently with their capital expenditures. They've exercised a lot more discipline than in the past. These companies are way more profitable than they were a few years ago. There's been big earnings announcements, made headlines from Exxon, Chevron, and some of the politicians were a little upset about the profitability. But oil still goes into everything, and this green revolution is going to take a lot longer than I think folks originally thought or hoped for.
Yeah. And historically, when oil prices have shot up, these oil companies have gone out and spent a lot of money taking on new projects, and they haven't really done that this time. They've been much tighter, and so they've retained a lot of this, and so the balance sheets now look outstanding. So they could even stand a little recession pretty easily.
Right.
And get through it with no problems. So their balance sheets look really good, and the forward-looking environment for them, because it will take. I mean, I'm all for green energy, but it's going to take some time. And in the meantime, we still need these oil companies producing, and they're still going to make profits.
Right. Okay, this is a chart showing the real yield. We get to the real yield by looking at inflation and subtracting the yield on the 10-year Treasury. So for the longest time, we were a negative real yield, which meant that we weren't getting paid much at all on a 10-year Treasury, and you're falling behind on inflation.
Yep.
Now, the most recent numbers here, you're getting a 4.57 yield on the 10-year Treasury, and inflation at the time was 4.39. So a slight positive on the real yield finally.
Yeah, we dropped way down for so long, so that's good news. And it might have even improved a little bit here recently because inflation's dropped a little bit more than when this was published back in September, at the end of September.
Or looking at the fixed income market here, it has been, as we mentioned, historic. If the market were to close today for the year, would be down 3 years in a row. Last year was a really tough year in fixed income as the Federal Reserve raised rates faster than most people expected.
13% drop in the bond market. I mean, it's just unprecedented.
And the 30-year U.S. Treasury was hit really hard last year. So year to date, still a lot of red up there, but not nearly as bad as last year. But the 10-year U.S. Treasury is down 3.4%. The 30 years down almost 10% after being hit hard last year. It's been a huge move. And the U.S. corporate market, the investment grade corporates are flat for the year, and U.S. aggregate, which has corporate and government bonds in there, are off 1.2.
Yeah, and I think the chart on the right, Mike, is an interesting one where down at the bottom you can see the dark line represents a 1% rise in interest rates and what would happen to bonds right now. And then the blue represents a 1% fall in interest rates and what would happen to that bond category. And you can see that with the exception of, you had the ag, the core, the 30-year, the 10-year, with the exception of those, even you're going to see and also the municipals, you would see an actual increase even, for the 1% rise in rates for a lot of those positions, including the two-year U.S. Treasury notes. But more importantly, if we get a 1% fall, look at the big movements you see for all of those positions. So attractive. I mean, you could be in a 2-year 1% fall and you get a huge bump in that category. So this is one of the reasons that we like bonds in this environment right now, because any kind of move downward in rates, is going to have a pretty significant positive impact on bond valuations.
Okay, this is the yield curve, which basically shows what do you expect to be paid the further out you go on a maturity. So you would think the chart on the bottom represents year-end 2021. You would have to if you lend your money out 30 years, you'd be paid 1.9. If you were only lending out short-term, you'd be less than 1%, which is what you would expect.
The bottom one represents a normal yield curve. Right. Fairly normal, even if it's still on the low side, but fairly normal yield curve.
The last few years, we've had an inverted yield curve, which means you're being paid more on the front end of this curve for the short-term bonds than if you lend your money out long-term. So the green line is year-end 2022. We had an inverted yield curve there. But what's interesting, just since that time, the front end of the curve has steepened even more, and we're seeing yields now in very short-term to 2-3 years out of over 5%, which is just a huge move from a few years ago. But it's a good opportunity for income investors for sure.
Yeah, so that's been a big move. I think the 10-year just moved up to about 5% recently too. So we've continued to see a bit of a steepening in the curve, which is always historically this kind of environment has preceded some type of recession. And the bond market's way bigger than the stock market, dwarfs the stock market, and really wags so that the stock market is the tail of the bond market, really. Mm-hmm. And so we do learn a lot from looking at the bond market in terms of what we expect to happen going forward in the stock market.
Our fixed income valuations here, a yield to worst, which means what's the worst yield I could expect, with the exception of a default, which fortunately are very rare. And the purple line represents the 10-year median. So just to look on the left-hand side in IG corporates, just corporate bonds, investment grade, the median has been a 3.2% yield, which is okay. But look at the move up now in the where that diamond is in blue, 6% yield to worst on corporate bonds, which is pretty attractive. That's a really safe bet. I don't have any problem picking up 6% there. And really across all these asset classes, U.S. Treasuries, you're at 1.6. Now you're, like you mentioned, close to 5% on a U.S. Treasury yield.
Yeah.
With very low risk, that's a good bet there.
Yeah, very attractive yields in this environment right now for across the bond categories.
Our time diversification, the volatility of returns. So stocks are the green bar, blue are bonds, and a 50-50 in brown. And 1 year, what are the range of returns you could expect going all the way back to the 1950s? Well, the blue stands out to me because a 13% move down in the bond market is not what you would normally expect, but that's exactly what we saw last year.
Yes,
that 13% was last year.
that was the worst the bond market has done since 1950. So that's how bad last year was for the bond market. I don't know if people realize how bad that was, but it was really bad.
And if you're in a 50-50 mix, probably last year, you're down close to 15% last year.
And
So
that was the worst for that category as well, since 1950.
But the good news is that we go further to the right on this slide, and most of us are long-term investors. The rolling 5-year worst case on the bonds was -2, and on a 50-50 portfolio was +1, and it gets even better as you go further out on your time horizon. So we really can't overreact too much and make an emotional decision on a one-year basis.
Yeah, and that's why we sort of stress when we look at your portfolios in terms of how much we have allocated to equities versus bonds or fixed income. You know, that fixed income category, that's what we want to make sure we have all of your income needs covered for at least the next 5 years, so that we don't have to sell any equities in a volatile down market, because we know it can go down a lot on a short-term period of time, but over a longer period of time, you're going to see it recover. All right, we're going to continue with our portfolio update, talking about, take some of the things that we're talking about from the market and how we're going to apply those to our portfolios. First, the changes described in the portfolio update reflect changes to our model allocations. The actual investments in any one account may vary from the model allocation due to some client-specific or account-specific circumstances. Taxable accounts may be allowed to drift away from our target model to limit capital gains exposure, and will generally hold different securities than tax-deferred accounts for tax efficiency purposes. In addition, an account may differ if a do not buy, do not sell restriction exists on one or more securities in the account, or if the account holds excluded positions. So know that, you know, we're talking about our model portfolios, but each individual's account may differ slightly due to some of these variables that we just talked about. We're going to talk about both our strategic ETF models and our tactical stock models. Now, the strategic ETF models, Mike, are what? They're old fund models that we've redone, and they, they're basically low-cost ETFs, right?
Yeah, we picked the lowest possible ETFs when we could, and the thought process is you're basically picking up what the market's giving you. So you're getting an index fund at very low fees, and then some low-cost bond funds as well, and you're basically going to get what the market gives you. And we've just gone in recently, and you might have noticed on your statements, it'll say RVA, WM, ETF, and then a number after it. So if you had a 50, that just means 50% stock, 50% bonds, and we built them in increments of 10.
Okay, and that sort of reflects the risk profile of the client too, whatever risk models that you're falling into.
Correct.
Yeah, and then the tactical stock models are just what they sound, right? They're both stock and bonds in those individual stocks and bonds, right?
Right. The more traditional portfolios most folks are familiar with individual stocks and bonds. Some funds are sprinkled in there to gain some more exposure to a certain sector if we're positive on it. But they are a lot of long-term stocks in that portfolio. But we do switch to stocks every rebalance.
Okay. So we're going to talk about strategic ETF models first and the changes we made there.
So we kept the stock portion the same, which is just the low-cost index models like the S&P 500, the mid-cap, the small-cap. We did make some changes to the fixed income portion, though. We rebalanced everybody just a few weeks ago for a fall rebalance.
Okay.
On the core bond area, we reduced the exposure of the 1 to 5 year investment grade bonds, and we took that allocation and we put it into a 2032 investment grade bond fund in the tax deferred accounts.
Yeah, and that had the effect of increasing the duration of the model, but locking in higher yields, right?
Exactly. Yeah, we saw a lot of opportunities, as you saw on that yield curve slide. We wanted to lock in some of these higher rates now in case the Fed does cut later next year.
Right, and this represents 50% of our overall bond allocation at any given model. So this is what that looks like.
Yeah, and this slide will just show you that ag there is just a good benchmark to look at, the aggregate bond fund, and that's currently 4.8% yield. So we're picking up with the two funds that we're using rather than using ag over 1% in yield. And we have a lower duration than the ag, so we've actually reduced a little bit of the risk while picking up more yield.
Yeah, and that this is different for this is the tax deferred accounts, so the IRAs and the Roth
Right.
IRAs, but the taxable accounts are a little bit different, right? We didn't make changes there to speak
No
of.
changes there, and if you have a taxable account, a brokerage account, you'd see an iShares fund. MUB is the ticker, a municipal bond intermediate fund that is our core bond holding in the taxable accounts. One move we made, we eliminated the preferred stock position, and we used that allocation to increase our high yield bond exposure. The high yield bonds are paying a higher yield right now, and we were also able to lower the costs on the expense ratios.
Yeah, we're always looking to keep costs as low as possible for clients in their performance. So this is what that looks like, right?
Yeah, so the yield on the preferred stock fund was 6.8, but high yield bonds now are paying all the way above 9%. So a really big difference we were able to pick up in yield, and we lowered the duration. Preferred stocks don't really have a duration. They're sort
Right.
of, perpetual instruments, but big savings on the expense ratio. So we think that's really going to make a difference going forward.
And on the taxable accounts, we really have the Van Eck High Yield Muni Bond Fund in there for this sleeve, right?
Right.
And this represents about 25% of our fixed income allocation overall in our ETF models.
Okay, no changes to the short-term bonds. We really like the ultra short-term bond right now, ICSH. With these bonds are maturing in the next few months, really, but we're getting an over 5% yield right now for taking on almost no risk.
Yeah, that's what this looks like. It's a 5.66% yield over the SGov, which is the benchmark that we were looking at, with a little bit longer duration, but not much.
Yeah.
In taxable accounts, we're using the J.P. Morgan ultra short municipal income ETF in those accounts for this particular 25% allocation. All right, well, let's talk a little bit about the changes we made in the tactical stock models.
We decided to shift everybody slightly more into bonds on our last rebalance, and a couple of reasons for that. First of all, just the geopolitical uncertainty, the fact that we mentioned before, stocks aren't a real bargain here. The price earnings multiple is still a little elevated, but a big part of it is the opportunity we're seeing in bonds and short-term bonds right now are just we would have killed for this a couple of years ago to be getting these kind of yields with the opportunity for price appreciation. If the Fed does have even a minor cut in the next few years, it's a really good opportunity where you could see equity-like returns in the bond market with far less risk.
That's a nice position to be in, to be able to get those kind of returns with less risk. That's always a good place to be. And we also we reduced the number of individual stocks significantly so that we could focus on our highest conviction positions where we could get the biggest return potentially if we make the right bet on these stocks. They are high conviction positions, so we're going to give them the leverage in the portfolio to make them. If we're right, they'll have a bigger impact.
Right.
And also energy. We really do have an overweight to energy now, Mike. Why is that?
Energy right now, despite having a pretty good couple of years here, energy stocks are still fairly cheap, very profitable right now. They've done a remarkable job in the last few years shoring up their balance sheets, and they've actually exhibited some discipline in their capital expenditures where in the past when energy prices really moved up, there was a rush for more projects, more drilling, some very expensive projects that sometimes didn't pan out and also had the effect sometimes of pushing energy prices down too low. Now they're in a range where they feel they could be profitable here. They're not dumping a lot more capacity on at higher prices. They're really more shareholder friendly than they were a few years ago. And if there is a escalation in the Middle East, I think energy stocks could do very well in the next few months.
Yeah, so this is more of a tactical move right now to be overweight that sector, because that's a high conviction bet on our part that over the next 6 months or so, that's where we might see the biggest potential upside.
Correct, yes.
And so these are some of the changes we made.
Yeah, we eliminated some positions. Partially, some of them had just had really nice runs, like the home builders, like Toll Brothers. We also, as you mentioned, we wanted to have more of an impact, so fewer names, but a slightly larger position in each of the names. The financials we cut. They're in a challenging environment right now. We eliminated the amount of funds, and we were underweight on consumer discretionary versus the S&P. So we picked up a position there in consumer discretionary, which gains exposure to Tesla, which we don't have that stock in the portfolio, right. And Amazon is a big weighting in that fund as well. And we added a few really high conviction stock ideas, and the first one is ASML, which is a Dutch chip manufacturer that is very inexpensive in our opinion. We picked up Cordiva, which is in the agricultural space, and MasterCard.
Yeah, so all of those we believe are going to give us the bigger upside. Now, we got rid of Dr. Horton and Toll Brothers because they just really did extremely well. Like, they were high conviction buys of ours last year, and they really did perform outstanding. But now we see other opportunities are just better out there, so that's why we're cutting those. Now, some of these I know were not easy to cut because, companies like Lockheed Martin,
Corning,
we really, there's a long-term bets, but hey, we needed to cut. From an upside perspective, we think there are better upsides.
Yes, and we needed some money to shift into bonds as well, where we really like the risk reward right now.
Right.
So this chart here will show how our weightings are versus the S&P weightings. So the biggest overweights right now in the portfolio are energy, material, and industrials, and we have slight underweights in communications and technology and financials right now.
Yeah, so you can sort of see where our conviction is. We believe in those materials. We believe in energy right now. We think those have the best upside going forward. But even though we are slightly underweight some of those other sectors like technology, we still are only slightly underweight. We still have holdings along those lines. This is underweight, overweight versus the S&P 500. That's what we're looking at here. So we still have significant holdings in the technology sector because that's a big part of the S&P.
Right.
So we still have those. So that's, we're going with what we think the market will give us right now and where we have the greatest upside potential from what we can see out there to give us some nice returns in this environment, because it's a very challenging environment. All right. Any questions, please email team@rvawm.com. And we will get back to you as promptly as possible with answers. Appreciate you taking the time to watch our market update. Hopefully this is beneficial for everyone. We also appreciate your confidence in us and trusting us to work with you in managing your portfolio and working on your financial plans. So really appreciate that from everyone and look forward to seeing you at our next meeting. And keep in mind that if your next meeting is next year, you will be at our new location on Cox Road here, right down the street. So we will let you know and give you the new address and everything before you come to your next meeting. We'll probably have an open house in January since we're moving in December. And I hope everyone, if I don't see you before the holidays, have a great holiday season. And we look forward to seeing you at our next meeting. Take care.